Usually when we talk about a medical diagnosis, right, there's this underlying expectation of precision. It feels almost like engineering.
Right. It's very clinical.
Exactly. Like you fall off a bike, you break your arm, and the x-ray comes back showing that jagged white line right across the bone. And the doctor just points at the film and says, there it is.
It's entirely binary. The bone is either intact or it is compromised. I mean, there is no debate there.
Yeah, broken or not broken. It's clean. We like things to be visible and categorized, neatly boxed up. But then you step into the world of financial markets, and suddenly you realize that the x-ray machine is it's fundamentally broken.
It really is.
We're all staring at this diagnostic landscape that is entirely murky. I mean, you pull up a stock chart on your screen, and what are you actually looking at?
It's chaos, honestly.
Yeah, it's just this chaotic, jagged line of raw human emotion. It's millions of instances of fear and greed painted over days and weeks in these red and green candlesticks. Yet as traders, we are all desperately looking for that clean, binary x-ray film.
Right, everyone wants the easy answer.
We want an indicator that cuts through the noise and just says, buy right here, sell right here. And today, we are doing a deep dive into an indicator that promises exactly that level of clarity.
Or at least it appears to promise that.
Right, exactly. A tool that is so visually simple, it almost feels like you've found a cheat code for the market.
Visually simple is, well, it's the perfect way to describe it, but the harsh reality is that it's fundamentally misunderstood by the vast majority of retail traders who attempt to use it.
Oh, totally.
They see the visual simplicity and they just assume the underlying mechanics are equally simplistic, which is, I mean, that's a really dangerous assumption.
Well, let's pull it apart because today we are talking about the Parabolic SAR. And to you listening, whether you're a seasoned algorithmic trader who's, constantly tweaking your execution models, or maybe you're relatively new to the technical analysis space and just trying to make sense of the overwhelming amount of indicators available on your platform, our mission today is to completely decode this specific tool.
It's a very necessary mission, too.
Yeah, because we've been synthesizing an absolute mountain of intelligence for this deep dive. We're looking at foundational frameworks from Investopedia and CMC markets. We're pulling institutional-grade volatility data from the quantitative team at LuxElgo.
Which is fantastic data, by the way.
Well, it's incredible. And we're heavily analyzing some incredibly rigorous, data-driven backtesting from analysts like Ezekiel Chu, Trading Rush, and Mind Math Money.
Right.
These are people who aren't just theorizing about chart patterns, right? They have run the numbers hundreds of times in live market conditions. And looking at all their data collectively, the Parabolic SAR operates a lot like a GPS navigation system.
That GPS analogy, it maps perfectly onto the data we're seeing, especially when you look at how the indicator performs in different market environments.
Right, because think about it. If you're cruising down a clear, open highway out in the middle of nowhere, your GPS is flawless.
It works exactly as intended.
Yeah, it tells you exactly how fast you're going. It tracks your momentum perfectly. It calculates exactly when you'll arrive at your destination. The environment is perfectly suited for the technology. But, and here's the catch, if you take that exact same car and drive it into a dense, confusing, gridlocked city with massive skyscrapers bouncing the satellite signals all over the place,
the signal gets scrambled.
Exactly. Suddenly your GPS is totally confused. It tells you to turn left into a brick wall or, merge right into a lake.
Right, but the underlying technology of the GPS didn't suddenly break.
Right, it's the same machine.
Exactly. The tool is operating exactly as it was programmed to operate. The issue is that the environment changed around the tool and the driver failed to adjust their reliance on it.
That makes total sense.
The market is no different. Today is really about separating the underlying math from the retail myth. We're not just going to walk through the mechanics of placing these little dots on your chart.
No, we're going much deeper than that.
We're going to dissect the actual formula to understand why the market forces those dots to accelerate, and more importantly, how you can construct a framework around them to shield your capital, rather than, walking blindly into a trap that liquidates your entire portfolio.
Okay, let's unpack this. Because before we can start building a bulletproof multi-time frame trading system, we have to understand the anatomy of the tool itself. We have to look at the engine block. So let's talk about the acronym. SAR. S-A-R. It stands for stop and reverse.
Stop and reverse, yes.
And the history of this indicator is actually fascinating because it wasn't cooked up in the last 5 years by some high-frequency trading firm using AI or anything. It was developed way back in 1978 by a mechanical engineer named J. Wells Wilder Jr.
And Wilder is arguably one of the most influential figures in the history of technical analysis.
Really?
Oh, absolutely. This is the exact same mathematical mind that created the relative strength index, the average true range, and the average directional index.
Oh, wow, the RSI. He made the RSI.
Yes, he was a giant in the field. And what he was trying to solve with the parabolic SAR was the problem of tracking momentum in a way that inherently managed risk.
Okay, so for the listener, if you've never applied this to a chart, imagine your standard price action layout. You have your red and green candlesticks. When you activate the parabolic SAR, it overlays a series of individual dots on the chart.
Right, it doesn't draw a continuous line like a moving average would. It just prints a single dot for every single candle.
Just one dot per candle.
Correct. It's discrete plotting. When the market is in an established uptrend, these dots print entirely below the price candles. They essentially form a dynamic floor that trails upward as the price climbs.
So visually, it's signaling to the trader that momentum is currently with the buyers. The structure is holding, so you stay long.
Exactly. But the critical mechanic happens when that upward momentum stalls and the price drops down and physically touches that floor.
It hits the dot.
Yes. The moment the price intersects with the dots immediately stop printing below the price and they instantly jump to print above the price candles.
Hence the name, stop and reverse. The indicator is literally telling you to stop your long position and reverse into a short position.
And conversely, when those dots are printing above the price, they form a descending ceiling. It indicates a downtrend, momentum is falling, the sellers are in control, and you should be looking for short setups. Every single time the price touches the dot, whether from above or below, a reversal is mathematically triggered.
The visual elegance of it is brilliant. I mean, you can glance at a chart for a fraction of a second, see where the dots are in relation to the candles, and instantly know the assumed direction of the macro momentum.
It is very visually appealing.
But we need to get into the weeds of the math here. Because Wilder was an engineer, and the way these dots trail the price isn't a linear progression, right? They don't just move up by a fixed percentage every day.
No, they curve. They accelerate to form a parabola, which is why it's the parabolic SAR.
The parabolic SAR. Got it. So how does that curve actually work?
Well, the mathematical curvature is the entire genius of the indicator. The formula is specifically designed to accelerate as a trend matures.
Okay.
If we break down the basic calculation, the new SAR value equals the prior SAR value, plus the acceleration factor, which is then multiplied by the difference between the extreme point of the trend and the prior SAR.
Okay, wait, hold on. That sounds like a college calculus syllabus. Let's translate that into trader psychology. What exactly is the acceleration factor? Because from everything I'm reading in the Investopedia breakdowns, that variable seems to be the beating heart of this entire system.
It is the engine. The acceleration factor, or the AF, dictates how aggressively the dots chase the price. By default, the settings Wilder designed in the 1970s, the AF, starts at a value of 0.02.
0.02.
What this means is that at the very beginning of a new trend, the dots are moving relatively slowly. They are giving the price a lot of breathing room. But every single time the price makes a new high in an uptrend or a new low in a downtrend, that acceleration factor steps up by another 0.02. So it goes from 0.02 to 0.04 to 0.06 and so on.
Oh, so it's compounding its own speed.
Yes. It accelerates to catch up to the price. However, Wilder knew that if it accelerated infinitely, it would instantly crash into the price and end the trade prematurely. So he instituted a mathematical cap. The acceleration factor maxes out at 0.20.
Okay, so practically speaking, if I'm staring at a daily chart of Apple or Tesla, what does that mathematical acceleration actually look like as a trend plays out over a few weeks?
At the genesis of the trend, the gap between the dots and the price action is wide. The indicator is essentially saying the trend is young, let's give the asset room to experience normal daily volatility without getting spooked.
It's giving it some slack.
Exactly. But as the trend proves itself by consistently hitting new highs, the math forces the dots to move faster and faster. The gap between the dots and the price shrinks aggressively. The indicator actively tightens its grip on the price, squeezing it, until eventually the price has no room left to breathe.
Wow.
At that point, even a minor pullback will cause the price to hit the dot and trigger the reversal signal.
I picture it like a hunting dog running after a rabbit. At the very beginning of the chase, the dog is just jogging, sort of mapping out the rabbit's general trajectory. But the longer the chase goes on, the more confident the dog gets, and it starts sprinting faster and faster. Eventually, it's right on the rabbit's heels, and any sudden change in direction by the rabbit ends the chase immediately.
That is a highly visceral analogy. but it maps perfectly onto the market dynamics.
It makes sense to me.
Yeah, the further a trend extends, the less leeway the indicator allows for pullbacks. It assumes that a mature trend should be accelerating, and if it stops accelerating, the trend is likely exhausted and you need to get out.
But wait, if it's this simple, just buy when dots are below and sell when dots are above, and let the accelerating parabola manage your trailing stop. Why do people lose money?
That is the million-dollar question.
Right. It almost feels like cheating.
Mm-hmm.
Ezekiel Chu's Gata points out that beginners look at this and think they've found the holy grail of trading. It feels like you don't even need to think, you just follow the dots. So where's the trap door?
The trapdoor is hidden in the fundamental nature of how financial markets actually behave versus how we wish they behaved. Ezekiel Chu brings up a foundational market concept known as the 80-20 rule. And this is the harsh, unglamorous reality that brokerage commercials never mention. The market only truly trends about 20% of the time.
Wait, really?
Okay.
Just to be incredibly clear on that metric, you were saying that 80% of the time the market is essentially doing nothing productive.
In terms of directional momentum, yes. Only 20% of the time is a given asset making a clear, sustained structural move to the upside or the downside. That 20% window is the open highway for your GPS. That is the environment where the parabolic SAR operates with absolute sheer magic. It catches the bottom, trails the massive run, and gets you out near the absolute top. But the other 80% of the time, the market is just chopping sideways.
It's just bouncing around.
Exactly. It's consolidating, it's ranging. Buyers and sellers are locked in a stalemate, fighting over the exact same narrow territory of price.
And during that 80% consolidation phase, what is happening to our elegant, mathematically accelerating dots?
They're completely self-destructing.
Oh, man.
The mathematical formula of the SAR is blind to macroeconomic context. It doesn't look at the news. It doesn't look at volume. It doesn't know the market is taking a breather. It only looks at the relationship between the extreme price points.
Right. The math doesn't care about the news.
Precisely. So, in a sideways ranging market, the price will bump up a few dollars, hitting a local high. The math instantly reacts, flipping the dots below the price and shouting buy at the trader. But because there is no actual trend, the price immediately rejects that high and bumps down a few dollars. It touches the newly formed dots, causing them to immediately flip above the price, shouting sell.
It just becomes a metronome of false signals. Buy, sell, over and over in a tight range.
It will methodically chop your account to pieces. You will execute a dozen trades in a row, taking small but consistent losses on every single one, simply because you are trusting an indicator that is operating entirely outside of its intended environmental parameters.
So the market is chopping sideways 80% of the time, and the default settings of the SAR, that 0.02 acceleration step and the 0.20 maximum cap, were designed by a guy in the 1970s analyzing physical commodities like wheat and gold. Blindly relying on those defaults for everything today seems incredibly dangerous. It feels like we were trying to use a 1970s dial-up modem to trade modern algorithmic markets. We have to be able to tune this engine right.
Customization isn't just an option, it is mandatory for survival. You simply cannot trade a highly liquid, slow-moving blue-chip stock like Apple using the exact same sensitivity settings you would use to trade a hyper-volatile cryptocurrency like Bitcoin.
They're entirely different beasts.
Exactly. The sensitivity of the indicator must be fundamentally tuned to match the natural heartbeat and volatility of the specific asset.
This aligns perfectly with the institutional data we pulled from Luxalgo. They broke down exactly how to tune the SAR based on the inherent volatility of what you're trading.
Their breakdown is excellent.
Let's look at their framework for low volatility assets first. If you are trading legacy blue chip stocks companies with massive market caps that don't typically swing 10% in a single day, Luxalgo suggests drastically slowing the indicator down. They recommend dropping the acceleration step from the default 0.02 down to somewhere between 0.015 and 0.018 and lowering the maximum cap to 0.15 or 0.18.
And if you understand market mechanics, the logic there is bulletproof.
How so?
A massive blue chip stock moves very deliberately. It has heavy institutional backing. Mutual funds and pension funds are constantly buying and selling in vast quantities. Because of that massive liquidity, it doesn't whip around wildly. It grinds upward or downward. If your indicator is too fast and too sensitive, you're going to get shaken out of a perfectly healthy, slow-moving macro trend just because of normal daily background noise.
That makes a lot of sense.
Yeah.
Then if you move up to medium volatility assets, this is where Luxalgo categorizes things like major forex pairs, gold, crude oil, and standard commodities. He suggests keeping it right around Wilder's original defaults, a 0.02 step and a 0.20 max.
Which is what it was designed for originally.
Right, but then we cross into the high volatility arena, cryptocurrencies, tech stocks with low floats, assets that can easily swing 5% to 8% in a single afternoon based on a single news headline. For these, Luxalgo suggests speeding the engine up significantly, increasing the step to 0.025 or even 0.035, and pushing the maximum cap up to 0.25 or 0.30.
Mind Math Money actually echoes this exact sentiment, but they approach it from the perspective of timeframes rather than just asset classes.
Oh, interesting. How do they break it down?
They point out that if you are a day trader or a scalper working on a hyper-fast 5-minute or 15-minute chart, you inherently want those faster settings, like a 0.03 step. Faster settings tighten the bands around the price. They allow you to react instantly to sudden, violent shifts in intraday momentum.
Okay, so you're hugging the price closer.
Yes. Conversely, if you are a long-term swing trader looking at daily or weekly charts, holding positions for months, you want to slow the mathematical engine way down, maybe even down to a 0.01 step. Slower settings create a much smoother, wider track that ignores the daily chaos and keeps you in the macro trade.
While we're talking about customizing the setup, Mind Math Money also had a really brilliant, purely visual tip for anyone using platforms like TradingView. By default, most charting software prints the parabolic SAR as these tiny, almost invisible little crosses or microscopic dots.
They're very hard to see.
Yeah. He strongly recommends going into your visual settings and changing them to large, high-contrast circles, solid bright green for bullish dots and solid bright red for bearish dots.
It sounds like a superficial change, but visual clarity directly reduces cognitive load. When you are operating in a live market, making split-second decisions with real capital on the line, the absolute last thing you want to be doing is squinting at your monitor, trying to figure out if a tiny gray cross just printed above or below a wick. You need the signal to be instantly, undeniably readable.
Okay, but here's where it gets really interesting. I need to look closer at this idea of speeding up the indicator for volatile assets like crypto.
Yeah.
If I am trading Bitcoin, which is notoriously erratic and prone to violent fakeouts, and I intentionally increase the speed of my SAR to 0.03 just to catch those rapid breakouts,
Yes.
aren't I just walking straight into a meat grinder? I mean, if I make the indicator more sensitive in a market that is already chaotic, doesn't that just mathematically guarantee I'm going to suffer from way more of that 80% sideways chop we just talked about?
You have just articulated the ultimate inescapable trade-off in all of technical analysis. There is no perfect setting because faster settings and slower settings both demand a sacrifice.
It's a double-edged sword.
Exactly. If you use faster settings, you drastically reduce your lag. This means when a real massive trend begins, you get your entry signal incredibly early and you capture the lion's share of the move. But the sacrifice is that a faster setting will undeniably trigger vastly more false signals during consolidation. It will chop you up more frequently.
And if I use slower settings?
If you use slower settings, you effectively filter out the majority of those false signals. You survive the chop, but the sacrifice there is lag. By the time a slow indicator finally confirms a trend and flips, the market might have already moved 10% or 15% without you. You missed the beginning of the move.
It's a permanent sliding scale.
Yeah.
You simply cannot have both early entries and zero false signals. The map doesn't allow for it.
It does not, and that is exactly why tweaking the settings is only step one of the process. Adjusting the sensitivity of your GPS doesn't solve the problem if you are still driving in a city that fundamentally scrambles the signal.
Right.
To make the parabolic SAR truly bulletproof, to survive the 80% of the time the market is trying to slowly bleed your account dry, you must build a comprehensive filter framework. You have to combine the SAR with completely different types of indicators to block out the noise.
The filter framework. This is where the deep dive transitions from theory into actual application. We're no longer talking about trading naked SAR dots on a blank chart. We are building a multi-layered system. And the absolute most foundational filter we found across all our sources, the one that Ezekiel Chu builds his entire methodology around, is the 200 EMA compass.
The 200-period exponential moving average. It is, without a doubt, one of the most widely respected and heavily watched long-term trend indicators in global finance. Institutional algorithms watch it, retail traders watch it, everyone watches it.
Chu says you have to treat the 200 EMA like a compass showing you true north, and the parabolic SAR is simply your machete for clearing the path in front of you. Here is his rule, and it's beautifully restrictive. If the current price of the asset is physically trading above the 200 EMA, you only exclusively take long SAR signals. You only buy when the dots flip below.
Right.
If the price is trading below the 200 EMA, you only take short signals. You only sell when the dots flip above.
Let's stop and really analyze the profound mathematical impact of implementing that one single rule. By adopting the 200 EMA as a directional filter, you have instantly, automatically filtered out 50% of the bad trades you would have otherwise taken.
50%, just like that.
Just like that. Because think about how a macro uptrend works. Even when a stock is on a massive tear upward over 6 months, it will still have red days. It will have weeks where it pulls back to rest. During those normal pullbacks, the fast-moving parabolic SAR will inevitably print a dot above the price, flashing a signal telling you to short the market.
Oh, I see.
But because the price is still broadly trading above that 200 EMA line, your system tells you to completely ignore the SAR. You step aside. You don't take the bait.
Chu has a great way of phrasing it. He says that taking a short SAR signal, while the overarching price is still above the 200 EMA, is exactly like stepping in front of a moving freight train to pick up a dime off the tracks. You might be right for a split second. The market might dip a little bit further, but eventually that massive macroeconomic momentum is going to reassert itself and absolutely run you over.
It's the difference between micro momentum and macro trend. The parabolic SAR tells you what the micro momentum is doing right this exact second. The 200 EMA tells you what the overarching macroeconomic flow of institutional capital is doing. You only ever want to put your money into the market when those two distinct forces are perfectly aligned.
We didn't just stop at Ezekiel Chu, though. We pulled several other filter combinations from our sources to see how different traders tackle this noise problem. Luxalgo, for instance, takes the moving average concept and makes it significantly tighter. They suggest a framework where you require the price to be trading above both the 10-period EMA and the 50-period EMA.
Which is much more sensitive.
Yeah, but they don't stop there. They also demand that the RSI, the relative strength index, must be actively reading above the 50 baseline before you're allowed to accept a bullish SAR dot. That is 3 independent layers of technical confirmation required before entry.
It creates a highly restrictive, incredibly selective trading environment. The market has to mathematically prove its short-term momentum via the 10 EMA, its medium-term trend via the 50 EMA, and its underlying buying pressure via the RSI, all before you commit a single dollar of your capital based on the SAR signal.
Then we have the alligator method, which was heavily featured in the backtesting data from Trading Rush. This one is highly visual and relies on Bill Williams' famous alligator indicator. For those who haven't used it, the alligator consists of 3 specific smooth moving averages shifted forward in time. You have the green lip line, the red teeth line, and the blue jaw line.
Right.
To take a long trade using this framework, you need the SAR dots to print below the price, but you also need to see the green lip trading above the red teeth and the red teeth trading above the blue jaw.
When those 3 lines stack in that exact order and begin to fan out away from each other, it visually represents an uptrend that is not only established, but is actively gaining strength. The market is opening its mouth, so to speak.
And the host of Trading Rush has this slightly crude but admittedly unforgettable rule for this specific setup. Don't let the alligator bite the balls.
Yes, I remember that one.
What he means by that is you have to look at your entry candle, the specific candlestick where the SAR dot officially flips to give you the signal. That entry candle should absolutely not be touching or intersecting the blue jaw line of the alligator or the 200 moving average. It needs to be visibly floating above them, demonstrating clear separation.
It's a brilliant visual heuristic.
Yeah.
If the price candle is still physically entangled with those major long-term moving averages, it means the price action is sluggish. It is mired in heavy structural resistance. It hasn't achieved escape velocity yet. You want to deploy your capital into momentum that has already cleanly broken free from gravity.
We also looked at the ADX filter, which comes straight from Investopedia, and is actually the specific filter that J. Wells Wilder himself recommended using alongside the SAR. The ADX is the average directional index. It's unique because it doesn't tell you if the market is going up or down. It solely measures the sheer strength of the current trend regardless of its direction.
Correct.
The rule is simple. If the ADX reading is below 25, the market is mathematically ranging. It is trapped in that 80% sideways chop zone. Investopedia explicitly states that if the ADX is below 25, you should essentially turn the parabolic SAR off. Just don't trade it.
The ADX below 25 is the ultimate objective do not enter sign. It saves you from trying to interpret whether the market is chopping or trending just by eyeballing the candles.
And lastly, in our filter framework analysis, Mind Math Money brings the entire conversation away from derivative indicators and back to pure, raw price action. They make the argument that every single moving average, RSI or ADX line is inherently a lagging derivative of price. Price is king. Therefore, you should be looking for established candlestick patterns to perfectly line up with your SAR dot flip. If the dot flips below the price, you don't just blindly buy. You look to see if that flip occurred simultaneously with a massive bullish engulfing candlestick or a clean breakout from a recognized bear flag consolidation pattern.
What you're building there is a confluence of evidence. When the mathematical formula of the SAR, the macroeconomic trend of the moving averages, and the raw, unfiltered human psychology displayed in a bullish, engulfing candlestick pattern all simultaneously point in the exact same direction, your statistical probability of success skyrockets.
Okay, I am listening to all of this, and structurally it makes total sense. But practically, if I put myself in the shoes of a trader sitting at their desk, if I am waiting for the price to pull above the 200 EMA, and I am waiting for the 3 alligator lines to perfectly fan out, and I am waiting for the ADX to cross above the 25 threshold, and I am waiting for a textbook bullish engulfing candlestick pattern to form. By the time all of those highly specific stars finally align, hasn't the massive move I am trying to catch already happened? Aren't I going to be entering the trade incredibly late?
That is the pivotal hurdle that separates amateur retail traders from seasoned professionals. The answer to your question is yes. You will absolutely be late. You will completely miss the absolute bottom of the move. And if you want to survive in this industry, you have to completely reprogram your brain to be perfectly okay with that.
Why? That goes against every instinct. Every single person who opens a brokerage account wants to buy the absolute bottom and sell the absolute top.
Because the desperate attempt to catch the absolute bottom is exactly how you lose all your capital. Trying to buy the bottom while a market is crashing is mathematically equivalent to trying to catch a falling knife barehanded. You might get lucky once, but eventually you are going to bleed out.
That's a grim picture.
But it's true. Professional trading is not about being the first person to the party. It is strictly about managing probability. Missing the first 10% or even 20% of a massive macro move is simply the premium you pay for certainty. Quality of setups will invariably trump the quantity of trades.
Quality over quantity.
Always. I would much rather take only 2 trades an entire month where both trades have an 80% probability of success because all my restrictive filters perfectly aligned, than take 20 impulsive trades a month on naked, unfiltered SAR flips and slowly bleed my entire account dry in the chop.
Okay, theory always sounds flawless in a sterile deep dive like this. It is easy to sit back and say, just wait for the filters. But what happens when we subject these frameworks to actual brutal real-world backtesting? Let's take all of this out of the theoretical classroom and put it into the crucible. Let's look at the actual data from the charts.
This is exactly where the quantitative data from Trading Rush becomes absolutely invaluable to this discussion. They didn't just cherry pick 3 or 4 highly successful historical examples to make a YouTube video. They programmed a grueling 200 trade simulated backtest using the Parabolic SAR, combined strictly with the alligator filter and a baseline moving average.
They ran this gauntlet on the gold against the US dollar chart, specifically using the 1-day time frame. And what I love about their methodology is that they intentionally divided the test into 2 diametrically opposed market environments, purely to prove the point we've been discussing about the 80-20 rule. First, they ran what they call the good market test.
Right.
In this simulation, the algorithm was only allowed to take SAR signals when the price of gold was visibly and cleanly trading above a 9-period EMA. This meant the asset was already in an established, strong uptrend. They were exclusively driving on the open highway.
And when the environment perfectly suited the mathematical parameters of the indicator, what were the statistical results?
The result over 100 trades was a 52% win rate. And when you look at the equity curve, the graph mapping the simulated account balance over time, it went up consistently at a 45-degree angle for the first half of the test. It showed steady, compounded growth. But interestingly, as the market conditions began to shift later in the timeline, the equity curve completely flatlined. It stopped making money, but crucially, it didn't lose the accumulated profits. Trading Rush developed their own proprietary grading system, and they gave this setup a TR score of 31.8 out of 100.
Now, you have to immediately contrast that baseline with their bad market tests.
All right. They took the exact same SAR strategy, the exact same asset, but they inverted the rules. They told the system to only take trades when gold was trading below the 9 EMA or when the moving averages were tangled and ranging sideways. They forced the GPS to navigate the dense, gridlocked city.
And the result?
The result was catastrophic. A dismal 34% win rate. The TR score plummeted to a completely unviable 16.2. And the equity curve was just a nightmare. It just continually tanked from the first trade to last. The analyst running the test explicitly warned his audience, stating point blank that trading this indicator in bad conditions will systematically blow up your account. The profit graph literally looked like a macro downtrend.
The hard data perfectly validates the theory of the 80-20 rule. In a ranging market, a momentum indicator transforms into a weapon of mass destruction aimed directly at your portfolio. But we cannot just gloss over the results of that good market test. We need to analyze that 52% win rate.
I was hoping we'd stop there because honestly, I looked at that 52% number and I was incredibly underwhelmed. We just spent 20 minutes discussing how to build this heavily sortified, multi-layered filter framework. You wait for the alligator, you verify the EMA, you check the momentum, and after all that incredibly patient discipline, you still only win roughly half the time.
It sounds low, I know.
It's barely better than a coin flip. It certainly doesn't sound like the magic cheat code beginners think it is.
This is a phenomenal observation, and it highlights a trap that almost all novice traders fall into. You are looking at the win rate in complete isolation. You are assuming that a high win rate equates to high profitability.
Does it not?
No. The parabolic SAR, by its very mathematical design, is a reactive tool. It is not predictive. It will never, under any circumstances, provide you with an 80% or 90% win rate. But what you have to understand is that a 52% win rate is exceptionally, life-changingly profitable if your winning trades are structurally significantly larger than your losing trades.
We were talking about the risk-to-reward ratio, the math of the payouts.
Precisely. To illustrate this, let's look at the brilliant case study provided by Mind Math Money. They analyzed the price action of the NASDAQ Q100 index during a specific historical period where the broader market suffered a sudden, massive 12% macroeconomic crash. It was an absolute bloodbath.
I remember that one.
But at the absolute terminal lowest point of that crash, the moment the selling pressure finally exhausted itself, the parabolic SAR cleanly flipped its dot from above the price to below the price. Because it is purely reactive, it perfectly caught the genesis of the initial pullback. And then, because of the accelerating math we discussed earlier, it stayed beneath the price and trailed the subsequent massive multi-week rally perfectly.
It locked onto a massive structural macro move and just rode it all the way up.
Yes. So let's run a hypothetical scenario to explain the math of the 52% win rate. Imagine you are executing a strict SAR strategy. Over a given month, you take exactly 10 trades. Because the market isn't perfect, you lose 5 of those trades. You get chopped out by false signals, and on each loss, your strict risk management stops you out for a 1% loss of your total account.
Okay, so you have taken 5 losses, and your portfolio is down a total of 5%.
Right. That is psychologically painful, but mathematically manageable. Now let's look at the 5 winning trades. Because the SAR trails massive trends like that NASDAQ Q rebound, your winners aren't small. Those 5 winning trades catch massive trailing trends, and each one generates a 4% gain on your account.
Let me do the math. 5 trades multiplied by 4% is a 20% total gain.
Exactly. You reconcile the math. A 20% gain minus the 5% loss leaves you with a net account growth of 15% for the month. You only had a 50% win rate. You were wrong exactly as often as you were right, but your account grew by 15%. This mathematical reality proves that the true genius of the parabolic SAR has absolutely nothing to do with perfectly timing the entry.
So the genius isn't the entry signal. Where does the real power of this indicator lie?
The power is entirely in how it forces you to manage the exit. The parabolic SAR isn't a crystal ball that tells you where the market is going. It is a mechanical shield that forces you to hold on to winners and cut losers.
If the math dictates that our entries are only going to give us a slight statistical edge, like that 52% win rate, then our exits and our risk management parameters absolutely must do all of the heavy lifting. They're the only things ensuring our long-term survival. How do we practically apply these dots as a shield?
The most fundamental foundational application is using the parabolic SAR as a dynamic trailing stop loss.
Let's walk the listener through the exact mechanics of this. When you analyze a chart, all your filters align, and you finally pull the trigger to enter a trade, you have to protect your capital immediately. So you immediately place your stop-loss order at the predetermined price level where your brokerage platform will automatically liquidate your position to prevent further catastrophic losses. And you place that stop-loss exactly at the price level of the very first SAR dot that just printed.
That is step 1. If you are entering a long position, your stop is placed at the location of the dot below the candle. If you are entering a short position, your stop is at the dot above. Your initial risk is defined the millisecond you enter the trade.
And here is where the mechanical advantage takes over. If you were using a standard slow-moving average as your stop loss, it would just slowly meander upward, leaving a massive gap where you could lose a lot of open profit if the market suddenly reversed. But the SAR accelerates.
It compounds at speed.
Right. As the trend matures and price climbs, the mathematical formula forces the dots to move up faster and faster. With every single new dot that prints on the chart, you manually log into your broker and move your stop-loss order up to match the exact price of that new dot.
You are dynamically, mechanically locking in open profits as the trend progresses without suffocating the price action.
The analogy that came to mind when I was mapping this out is a ratchet strap. If you ever load in cargo into the back of a truck, you use a heavy-duty ratchet strap to secure it. You pull the strap, and the gear mechanism clicks. It gets tighter and tighter, securing the load.
That's a great visual.
Yeah, but the beauty of the mechanism is that once it clicks forward, it physically cannot loosen. It only moves in one direction. The Parabolic SAR is a financial ratchet strap. As the price goes up in your favor, the trailing stop loss clicks tighter and tighter, relentlessly protecting your accumulated gains. But it never, ever moves backward. If the price falls, the dot stays exactly where it is until the price hits it and kicks you out of the trade safely.
It is a masterful system for removing human emotion from the exit process. However, as with every single concept in trading, there is a fundamental flaw in the basic textbook application of this trailing stop. And the research provided by Ezekiel Chu highlights this flaw perfectly.
You are referring to his hybrid exit system.
Yes. Chu makes a mathematically undeniable argument.
Yeah.
If you enter a trade and you simply sit there waiting for the SAR dot to physically flip to the other side of the price before you close your winning position, you are absolutely guaranteed to give back a massive chunk of your accumulated profit to the market.
Walk us through the mechanics of why that happens. If the dot is trailing the price so closely, why am I losing profit?
Because of the nature of the reversal signal itself. For the SAR dot to flip, the actual price action has to reverse significantly enough to plummet down and touch the dot. By definition, the price has to have already fallen considerably from its absolute peak before the indicator can register the change in momentum. You might be up $5,000 at the absolute peak of the candle, but to wait for the dot to flip, you have to watch the price fall, watch your open profit bleed down to $3,500, and only then does the indicator tell you to exit. You are consistently sacrificing the top 10% or 20% of every single major move, simply waiting for the lagging indicator to catch up to reality.
That sounds psychologically agonizing, watching thousands of dollars evaporate while you wait for a dot to appear. So what is Chu's structural solution to this lag?
He advocates for a hybrid approach that blends mechanical trailing with structural market analysis. He argues that you should never rely solely on the trailing SAR to manage your entire position. Instead, the moment you enter a trade, you should immediately zoom out, look left on your chart, and identify the very next major macro level of structural support or resistance.
So you look for the historical turning points.
Exactly. You identify where the heavy institutional supply zones are, and you set a hard, inflexible take-profit limit order at that specific level.
But he adds a crucial mathematical caveat to that hard target, right? He insists that the distance to that target must mathematically provide you with a minimum of a 1 to 1.5 risk-to-reward ratio.
The math is non-negotiable here. What that ratio means is that if the distance from your entry price down to your initial SAR stop loss represents a $100 potential risk, the distance up to your hard take profit target must represent a minimum of a $150 potential gain.
Okay, so the setup is complete. You enter the trade, you set your hard target at the resistance zone for a 1.5 multiplier, and you continuously manually trail your stop loss up with the SAR dots as they print. What happens next?
You completely remove your hands from the keyboard and you let the market decide how the trade ends. You let the price action dictate which order gets hit first. If the underlying trend is an absolute monster, a true macroeconomic shift, it will violently blast straight through your resistance target, cash you out for your guaranteed $150 profit at the absolute peak, and the trade is over. You won.
Beautiful.
Conversely, if it is just a normal, sluggish market move, it might struggle, reverse early, and hit your trailing SAR stop loss. Either way, you are protected. You lock in the profit at the structural peak, and you stop waiting for the lagging mathematical formula to take your money back.
I understand the defensive mechanics of that, but I am looking at this from the perspective of a trader hunting for the massive runners. If I intentionally set a hard profit limit order at the very first major resistance line, aren't I fundamentally defeating the entire purpose of utilizing a trailing stop in the first place?
How so?
Well, the SAR was designed to catch these massive, endless 1,000-point trends that run for months. If I voluntarily cash out at the first sign of historical resistance, I am guaranteeing that I will miss the moonshot.
What you are describing is the eternal, unwinnable psychological battle between the fear of loss and the greed of missing out. Yes, utilizing a hard target means you might occasionally miss a historic parabolic moonshot. But let's talk about what you also miss.
Okay.
You miss the absolute psychological devastation of watching a beautifully executed trade go $500 into the green, failing to take that profit off the table because you were blindly waiting for the lagging SAR dot to flip, and then watching helplessly as an unexpected news event causes the market to violently reverse, blowing past your entry and stopping you out for a $50 loss.
Oof. Yeah, you turned a massive, tangible win into a completely unnecessary loss just because you wanted more. That is the kind of pain that makes people quit trading entirely.
It destroys trader psychology. Taking guaranteed, mathematically sound profits at known structural resistance zones, adhering strictly to that 1 to 1.5 minimum ratio is the mechanism that funds your account. Those banked profits are the war chest you absolutely need to survive the inevitable strings of small losses you are going to suffer when the market shifts back into that 80% consolidation phase.
That makes perfect sense.
It is the purest definition of prioritizing professional, systematic discipline over amateur emotional greed. The old trading adage remains undefeated. You simply cannot go broke taking profits.
Let's pivot to the defensive side of that equation. Let's talk about the exact size of those small losses. Ezekiel Chu outlines another deeply crucial rule here, which he calls the 0.7% rule. Because there is a specific vulnerability with the SAR at the very beginning of a trend. Sometimes, when a market experiences a violent, sudden breakout, the price skyrockets. But the mathematical formula of the SAR takes a few periods to catch up.
Right, the lag we talked about.
That first dot that prints can be incredibly far away from your actual entry price. Going back to our analogy, the rabbit got a massive head start before the dog even realized the chase had begun.
And the mathematical consequence of that distance is severe. If you were forced to place your initial stop loss all the way down at that distant dot, the amount of capital you are risking on that single trade is disproportionately massive if the market instantly fakes out and reverses on you.
Chu argues that you simply cannot allow the market to dictate your risk like that. To prevent these massive account-crippling drawdowns, you must manually cap your total financial exposure. He mandates that you limit your maximum possible risk per trade to exactly 0.7% of your total available account capital. And you achieve this entirely through dynamic position sizing.
We need to explain the mechanics of position sizing very clearly, as it is where most retail traders fail.
Let's do it.
Let's assume you are trading with a $10,000 account balance. If you adhere to Chu's rule, 0.7% of that account is exactly $70. That means $70 is the absolute maximum amount of money you are legally allowed to lose on this specific setup.
Got it.
Now, you measure the physical distance on the chart from your entry price down to the first SAR dot. If that distance represents a $300 drop on a single share of the stock you are trying to trade, you obviously cannot afford to buy a full share.
Right, because if it hit your stop, you would lose $300.
Exactly, which shatters your risk parameters. So you use a position sizing calculator to determine exactly what fraction of a share or what specific micro lot size in forex you can purchase so that if the price plummets and hits that exact dot, your total realized loss is exactly $70, no more, no less.
It is brilliant because it mathematically neutralizes the market's ability to blow up your account in a single bad trade. You could literally suffer a catastrophic streak of 10 losing trades in a row, getting completely chopped to pieces by the worst market conditions imaginable, and your total account would only be drawn down by 7%. You still have 93% of your capital intact. You are still fully in the game, emotionally and financially capable of catching the next big trend.
Capital preservation is the only metric that truly matters. Survival is the foundation of profitability.
Loxalgo also weighed in heavily on the nuance of risk management, contributing a concept they called the buffer zone. And based on their institutional data, this is specifically vital if you are attempting to trade highly volatile, low liquidity markets like cryptocurrencies.
Crypto is a whole different animal.
It really is. Their research shows that if you place your hard stop loss order at the exact penny of the SAR dot's price, you are going to get slaughtered.
Yeah.
A completely normal, erratic Bitcoin price swing, just a random 5-minute algorithmic fluctuation, will wick down, hit your exact stop-loss price, liquidate your position, and then instantly reverse and rally to new all-time highs without you.
In institutional trading, they refer to that as getting whipsawed. And traders need to understand that this isn't always just random noise. The market algorithms deployed by massive market makers are actively hunting for liquidity.
Really? They're actually hunting for it?
Oh, absolutely. They know exactly where retail traders place their stops based on obvious technical indicators like the Parabolic SAR. They will intentionally push the price down to those exact levels, trigger all their retail stop-loss orders to absorb that liquidity, and then drive the price back up.
It is predatory, but it's the reality of the game. So Luxembourg's defense mechanism is to build in a buffer. They suggest calculating the exact price of the SAR dot and then mathematically adding a 1% to 2% buffer beyond the dot in crypto markets. If the SAR dot is sitting cleanly at $50,000, you do not put your stop at $50,000. You put it down at $49,500 or $49,000.
Right.
You intentionally give the trade breathing room to absorb those predatory liquidity hunts and erratic noise without kicking you out of the macro trend.
It requires slightly smaller position sizing to accommodate the wider stop while maintaining the 0.7% risk rule, but it dramatically increases your survivability in highly manipulated environments.
That makes total sense.
Finally, I want to highlight the framework provided by CMC Markets because it elegantly combines the concept of trend filtering directly with risk management. They advocate for a top-down time frame analysis called the double SAR strategy.
I found this approach incredibly logical. Let's say you are an aggressive day trader. You want to execute multiple rapid trades on a fast 15-minute chart. The CMC framework dictates that you absolutely do not start your analysis on the 15-minute chart.
No, you'd get chopped up.
Instead, you zoom all the way out and open the daily chart first. You look solely at the daily parabolic SAR. Let's say you are analyzing gold, and the daily chart is printing a steady, unbroken sequence of dots far below the daily price candles. The macro institutional trend is undeniably up.
By doing this, you are establishing a rigid directional bias based on institutional order flow, not intraday noise.
Exactly. Once you have established that the macro tide is coming in, then and only then do you drop down to your execution time frame, the 15-minute chart. And the absolute golden rule of this strategy is that on that 15-minute chart, you are only legally allowed to take long SAR entries. If the 15-minute chart suddenly prints a beautiful, textbook, perfect-looking short signal with a massive bearish candle, you completely ignore it.
You sit on your hands.
Because the daily chart has already dictated that the overriding institutional momentum is bullish. You only ever deploy capital in the direction of the macroeconomic tide.
It is a phenomenal, highly disciplined methodology to ensure that you are consistently trading with the immense flow of institutional money rather than trying to step in front of it and getting crushed.
Let's summarize where we are. We have dissected Wilder's underlying math. We know how to fundamentally tune the acceleration engine based on the specific volatility of the asset using Luxalgo's parameters. We've constructed a rigid, multi-layered filter framework using the 200 EMA and the alligator to block out the noise of ranging markets. And we've implemented institutional risk parameters, the 0.7% rule, and the dynamic ratchet strap exit. On paper, looking at this objectively, this is an impenetrable, fortified fortress of a trading system.
On paper, in a sterile backtesting environment, yes, it is mathematically robust. But markets are not traded on paper.
No, they're not.
They are traded in real time by deeply flawed, highly emotional human beings. Which brings us to the final, and unequivocally the most difficult, element of utilizing this indicator, the psychology of the trader actually pressing the buttons.
Because it is the ultimate truth of the market. None of this math, none of these perfectly tuned filters, and none of this back-tested data matters even a little bit if your emotional brain overrides the mechanical system in the heat of the moment.
Exactly. You can possess the most advanced, mathematically perfect GPS navigation system in the world, but if you look at the screen, decide you don't trust it, and choose to manually drive your car off a bridge because you felt like it might be a shortcut, well, the perfection of the technology is completely irrelevant. The failure is entirely human.
Ezekiel Chu dedicated a significant portion of his research to mapping out what he calls the love-hate cycle, which he claims every single beginner inevitably experiences when they first discover the parabolic SAR.
Oh, it's a very real phenomenon.
It usually starts when they apply the indicator for the first time. They happen to catch a massive 20% trending market. and they fall completely in love. They watch the dots perfectly trail a massive winner. They convince themselves they're a savant, that they have cracked the code of Wall Street.
All right, the honeymoon phase.
But then, inevitably, the macroeconomic environment shifts. The market enters that 80% sideways chop zone. The SAR dots start violently flipping every 3 candles. The trader takes 4, 5, 6 losses in a row. And suddenly, the love turns into violent hatred. They storm onto trading forums, they call the indicator broken, they claim it's a scam, and they abandon it entirely to go search for the next magic bullet.
What they are fundamentally failing to accept, and this is a conceptual failure, not a mathematical one, is that suffering small, consistent losses in a ranging market is practically woven into the DNA of a momentum indicator.
It's just part of the game.
It is a necessary feature, not a bug. The entire system is structurally designed to absorb small, strictly managed 0.7% losses during the chop, specifically to keep you engaged and present so you can capture the massive account-making runs during the 20% trends. If your ego cannot psychologically stomach being wrong 5 times in a row, you physically cannot use this tool.
It also requires a monumental effort to fight FOMO, the pure, unadulterated fear of missing out. Let's go back to Ezekiel Chu's freight train analogy to visualize this. Imagine you are staring at your screen. The price action of a stock is trading significantly below the 200 EMA. The macro trend is aggressively bearish. The market is bleeding out.
Okay, picture it.
But suddenly, out of nowhere, a massive explosive green candlestick spikes upward. It violently rejects the lows. And right on cue, a parabolic SAR dot flips underneath that massive green candle. It looks visually perfect. Every instinct in your body tells you that the ultimate bottom is finally in.
Your limbic system takes over. Your brain is literally screaming at you, buy it right now. You are going to miss the reversal of the decade. You're going to miss the absolute bottom.
But the mechanical system you built says no. The overarching price is still below the 200 EMA. Short setups only. Having the discipline to ignore that perfect-looking dot requires an iron will. You are literally forcing yourself to step away from a potentially massive winning trade simply because the long-term probability math dictates that it is most likely a trap.
And the brutal reality is that 9 times out of 10, it is a trap. In institutional terminology, it is a dead cat bounce. The market algorithms engineer a sudden price spike to trap retail liquidity. You buy in out of pure FOMO, and then the macro downtrend violently resumes, crushing your position and sweeping your capital.
Wow.
Adhering strictly to your systemic rules when every single human instinct you possess is screaming at you to break them is without question the hardest aspect of being a professional trader.
There is also a highly specific, deeply mechanical aspect to this psychological discipline that multiple sources across our research aggressively highlighted. And it revolves around the agonizing concept of patience. The rule is absolute. You must wait for the current candlestick to physically and permanently close before you are allowed to mathematically confirm a dot flip.
This cannot be overstated. Technical indicators run on real-time calculations. Let's say you are analyzing a 1-hour chart. The market opens, and 30 minutes into the hour, a sudden, unexpected macroeconomic news event hits the wires. The price violently spikes upward. During the formation of that specific 1-hour candle, the real-time math of the SAR formula triggers, and a dot flips below the price on your screen.
It's flashing bright green. The signal is undeniably there on the chart.
It is visible, yes, but the hour has not mathematically concluded. The candle is still forming. 15 minutes later, the institutional money decides to fade that news event. They dump their positions, and the price violently rejects that initial spike, crashing all the way back down to where the hour started. Because the price reverted, the mathematical formula of the SAR instantly recalculates its parameters dynamically, and that beautiful green dot that just flip it below the price, it will literally vanish from your monitor. It will dynamically repaint itself back above the price as a red dot, as if the bullish signal had never existed in the first place.
They call it repainting. And if you lacked the psychological discipline to wait, if you jumped the gun and took an impulsive, massive, long position mid-candle just because you saw a dot that later vanished, you are now trapped in a terrible underwater position, bleeding capital, with absolutely no mathematical indicator supporting your trade thesis.
You are trading on a ghost signal. The absolute hallmark of a disciplined trader is the ability to sit physically on their hands, staring at a flashing signal, and refusing to execute until the clock strikes the hour and the closing price of that candle is permanently, immutably recorded into the historical database of the chart. Only in that exact second is the mathematical flip of the dot truly confirmed.
When you distill all of this down, We have spent an hour unpacking Wilder's complex 1970s calculus, Lux Algo's institutional volatility bands, Ezekiel Chu's rigid EMA frameworks, and the brutal realities of trading Russia's backtests. But looking at the whole picture, it truly sounds to me like the absolute most critical foundational indicator you need to pair with the parabolic SAR isn't a moving average or an RSI. It is your own internal capacity for patience.
I would agree with that assessment entirely. The romanticized Hollywood version of trading is screaming on a phone and making split-second gut instinct decisions.
Right, like the Wolf of Wall Street.
Exactly. But the reality is that highly profitable professional trading is incredibly painfully boring. Amateurs trade for the adrenaline spike of excitement. Professionals trade for the flawless execution of a mathematical system.
That's a great distinction.
It is about sitting at a desk, sometimes for agonizing hours or even days, simply waiting for the perfect, undeniable alignment of the macro trend, the 200 EMA, and the confirmed dot flip. It is about trusting the math of your 0.7% risk limit when you are absolutely terrified that the market is collapsing around you, and conversely trusting the mechanical discipline of your trailing stop when you are overwhelmed with greed and desperately want to cash out early.
It is the triumph of mechanical, statistical execution over raw, emotional reaction.
That is the essence of quantitative trading.
Well, let's pull back and briefly recap the massive journey we have been on today. We started by looking at a tool that, at first glance, appears to be a retail trader's magic wand, a simple, elegant trail of dots that ostensibly tells you exactly when to buy or sell. But as we peeled back the layers, we discovered that the parabolic SAR is absolutely not a standalone predictive solution. It is a highly effective, mathematically accelerating execution tool designed to trail momentum.
Perfectly summarized.
But in order to survive the 80% of the time that the market is actively trying to chop your account to pieces in a sideways range, that tool must be heavily protected by a macroeconomic trend filter, whether that is the 200 EMA, the alligator, or the double SAR timeframe check. And it absolutely must be paired with strict, emotionless mathematical risk management frameworks like dynamic position sizing.
It is analogous to handing a scalpel to a master surgeon versus handing that exact same scalpel to a toddler. The physical tool is absolutely identical, but the operational framework, the discipline, and the context surrounding its use dictate whether the outcome is a life saved or a catastrophic injury.
Now, to you listening, we want to hear from you. After everything we have unpacked, dissected, and analyzed today, do you currently utilize the parabolic SAR in your own active trading setups? Have you ever fallen victim to the love-hate cycle, getting chopped up by using it in ranging sideways markets? And if you are currently using it successfully, how does it specifically integrate into your system to help you identify macro trends or mathematically manage your trailing risk? We always love hearing how these theoretical tools are actually applied in the wild trenches of the market.
Before we officially wrap up this analysis, I want to offer one final lingering thought for everyone to mull over, specifically based on the historical context we discussed at the beginning. J. Wells Wilder Jr. finalized the invention of the parabolic SAR formula in 1978. When he designed the accelerating variables and the maximum caps, he did not have access to high-speed, liquid-cooled algorithmic servers.
No, he didn't.
He did not have software like TradingView feeding him real-time millisecond tick data from global exchanges. He calculated these complex dynamic variables entirely by hand, relying on a pencil, physical graph paper, and end-of-day closing prices from the commodities pits.
He built a quantitative engine using analog tools.
Yes. Now, I want you to truly consider the profound implications of this. If a mathematical equation, painstakingly written out by hand on a piece of paper in the late 1970s, can still be actively used today to accurately and profitably track the hyper-fast, algorithmic, globally decentralized, chaotic movements of an asset like Bitcoin, what does that empirically tell us about the completely unchanging, fundamentally permanent nature of human greed, fear, and overarching market psychology?
That is an incredibly profound realization. The underlying technology changes at light speed. The specific assets we trade evolve from wheat to digital currency, but the underlying human animal that is actually driving the price action on the chart is acting exactly the same today as it did 50 years ago.
The dots are not mathematically tracking the movement of money. They are mathematically tracking the movement of us.
And on that deeply philosophical note, we will leave you to your charts and your backtesting. Just remember, the next time you fire up your trading platform and load up your indicators, take the time to figure out exactly what kind of city you are driving in before you blindly trust the GPS to get you home. Thank you for joining us on this deep dive, and as always, keep exploring.